And welcome back. I'm Bob Pisani, and this is ETF Edge. Is China still investable? Regulatory risks are rising fast. Risks from both China regulators seeking to rein in everything from tech to education to food delivery services, and also from U.S. regulators like SEC Chair Gary Gensler, who is now calling for more disclosure from Chinese firms regarding their ownership structure. After a decade where investors have increased exposure to China, many are now debating whether China should be considered a separate asset class from the U.S. and indeed from the rest of the world. Joining us to discuss, Kevin Carter, who runs the Emerging Markets Internet and Commerce ETF. The symbol is EMQQ. They invest heavily in the Chinese consumer. Perth Toll is the founder of Freedom 100 Emerging Markets ETF, FRDM, that weights exposure to emerging market equities based on personal and economic freedom metrics. Kevin, we've talked about this for many years. You have repeatedly told me and emphasized invest in the Chinese consumer right now. Is that still feasible with this increased regulatory risk that we're having?
Well, I think it is. I mean, ultimately investing in China and emerging markets, the real story, the thing that's emerging are the people, billions of people moving on up, and they want stuff, more and better food, clothing, et cetera. And that's, in many ways, the biggest growth story in the world. And I think it's going to continue, but it's migrated to a smartphone consumption model. And these really are, amongst the best growth companies in the world. And China right now is trying to catch up with regulations. And this is not a China-only problem. This is something happening all over the world. You see it in the United States, where Apple and Facebook and Google are under attack by all quarters as well. So I think the market, however, has taken the China regulatory issues very hard. And as they say, you pay a high price for a cheery consensus. And these are some of the greatest growth companies in the world today. And fear has been very, very high.
Yeah, Perth, Kevin is saying stay focused on the consumer, on the emerging market consumer, and on private companies over in China. But is there a distinction anymore? Are state-owned enterprises in China, for example, and private enterprises now essentially all the same? Are they all controlled or owned by the Chinese government at this point?
Yeah, so by law, every Chinese company does have to have a Communist Party cell within their company. Every company's data, like these tech companies that Kevin's talking about, all their data belongs to the government, and they're not allowed to go out and raise foreign money if that compromises the data protections and the data privacy. And by privacy, I mean the government can access it, but no one else can. So there is really very little, maybe no distinction between state-owned and private companies in China. I mean, in other countries that have more personal and economic freedoms, then maybe, yes, there is a distinction. Our fund also excludes state-owned enterprises to bring that economic freedom theme all the way through. But that's just not enough in a country where everything is controlled by the government.
So is China uninvestable, Perth? I mean, I know you invest in companies from Taiwan and around the rest of the world. Are you saying to completely stay away from China altogether?
So our fund has absolutely no allocation to China. It's been that way since inception 2 years ago, and we're continuing that way now. And that's because of the lack of personal and economic freedoms. So we don't believe that there is a price at which we're willing to invest in companies that have to put state interests first. There's a price to doing business that way, and we don't want to be sitting here subsidizing that cost.
Shepard Smith here. Thanks for watching CNBC on YouTube.